All right, so let's look at some more factors of what affects the day-to-day stock movements of the market. And you're going to find some of these are a little repetitive. We're just kind of diving deeper into different kind of economic insights, but I want to really hammer in the point that there is a lot that makes the market move. And if you're trading, you have a lot to look at. And different stocks react to different things, which is why some traders stick within what you pretty much a niche, trading different types of different sectors or different types of stocks, because that way they only have to look at one or two factors as opposed to trying to figure out why the whole market is moving. So every day, the stock prices seem to fly every which way like a roller coaster. One day the market's up, the next day it's sideways, the next way it's crashing down, and then it's back up again. The price fluctuations in the stock market basically depend on these important factors. We talked earlier about the factors that affect individual companies and price movements, such as earnings and analyst reports. And here we're going to examine some more general factors that tend to influence the market as a whole. This is important because 3 out of 4 stocks follow the general market. So first we have internal developments. All the developments, large and small, that can affect the price of a stock, including mergers, earnings, dividends, suspensions, and so on. Even the news development of a launch of a new product or new company can affect the stock market. For example, Apple announces a new product and its price pushes other tech companies' prices down. So this is to say, let's say LG comes out with a super new high performance TV that's like 6K. We're only at 4K at this time of recording, so who knows? Maybe by the time you're watching this, they've come up with 6K. And investors and traders are like, whoa, this is the greatest thing ever. So we're going to invest in this. And you know what? Samsung and Sony, they're kaput. LG's just won the TV market. So even though the news is only about LG, people will pull out of the other two to go to LG because they think LG is now the latest and greatest thing. So that's just one example of how internal developments of one company can sometimes affect other companies or an entire sector or part of the market. Next, we have world events. And these events are just events taking place around the globe. This is definitely the hardest to track. For any of you who've tried to keep up with what's going on in the world, it's crazy. You're trying to keep track of, a couple billion people. It's hard. So the events taking place within the doors of the company can be just as impactful as those, happening around the world. You have war, civil unrest, impeding government regulation, natural disasters. For example, negative news in the Middle East often, even if the oil company has no interest in the region. Say company, or I'm not going to name individual countries here, but let's say country A is, suddenly has a new coup, and Exxon has interest in company C. I mean, even though they're a couple thousand miles apart, everyone looks on the news and they're like, oh no, they just kind of blow it. And this is, again, things are always blown out of proportion, and people are irrational when it comes to news. So even though country A has nothing to do with what's going on in country C, where Exxon is, Exxon might drop just because a couple thousand miles away, some bad stuff is happening. Next, we get to some more economic type stuff, which is inflation and interest rates. And inflation and interest rates tend to affect the stock market and stock prices directly. And this is one of the major disadvantages of stocks as a paper asset. Or I should say, increases in interest rates is normally followed by a sell-off in stocks as investors move from stocks to bonds as they just chase a better return, a better yield. Next, we have exchange rates. And if you're investing domestically, normally this doesn't really have a big factor playing on what you're doing. But foreign exchange rates can directly affect stock prices. When exchange rates increase or decrease, stock prices tend to fall and affect the market adversely when there's sharp movements with exchange rates. And finally, the strongest by far out of these 5 factors. And that's because it's normally a result of the other 4, and I've been hinting to it as we've been going through. and that is hype and fear. When a hot new company is having an IPO or a new product is launched, or just think about the dot-com boom, anticipation, excitement, and greed run the market. Anticipation, excitement, and greed run the market. These types of times of hype and fear are known as bull markets and bear markets, respectively, which we're going to discuss next. First, we're going to talk about bull markets. What is a bull market, and how do we deal with it? A bull market is characterized by a general rise in prices with the expectation that current growth will continue and increase into the future. This concept can also be applied to individual stocks as well as the market as a whole. For instance, if an investor believes that a stock price is on the rise and will continue to rise, they might say they are bullish because they think the stock price is going to keep going up, to signify they believe there's still room for the price to go. So how do we tell if market sentiment is bullish? So here are a couple of telltale signs. The occurrence of bull markets are normally preceded by investors confident and upbeat, while analysts' expectations are very optimistic. In the beginning, the increases in market prices may or may not be accompanied by strong corporate earnings or economic data, but prices will continue to increase on the assumption of continued growth. So stock prices will continue to go higher and higher and higher, even if there's no actual real-world results to support the new high levels of prices. So here's the best way to deal with these bull markets. The short answer is run. As an investor, run. As a trader, do your thing, get in, get out quickly, play your little games. But as an investor, you run. And bull markets almost inevitably turn into bubbles. And a bubble is simply an extreme bull market that gets out of control. And bull markets are always followed by a bear market, which is what we'll talk about next. Market bubbles such as the dot-com boom of the early 2000s, the mortgage crisis of 2008, are both examples of what happens at the end of a bull market, and that's why you run. Since they always end in disaster, as an investor, you need to steer clear of the stock market when prices get out of control. As a trader, there are ways to take advantage of the madness of the market using techniques such as hedging and shorting, but these techniques are extremely advanced. And actually shorting during a bull market is really dangerous, but people still do it. But for both traders and investors, the money is made when the bull market crashes. For example, as a trader, you can make phenomenal returns as the market crashes by shorting stock, which we can talk about later. And as an investor, you make phenomenal returns purchasing stocks at their inevitable bear market lows. So whichever path you choose, you make your money when the crash happens, not during the giant run-up. Many fortunes have been lost by people who've tried to time the top of the bull market. Maybe they buy one day and they say, I know it's going up and I know it's going to crash, but maybe if I could just get in and out real quick towards the top, we'll make a bunch of money. And most of them get burned. Remember, over 90% of traders lose all their money. So unless you really know what you're doing, just don't play with it. Just be patient, wait for the thing to crash and burn, and then build up a great portfolio with awesome, low-priced, cheap stocks. Because even good companies go down with the ship. Remember, 3 out of 4 follow the market. It could have record earnings that year, and the stock price will still be down, and it makes a great buying opportunity. And that's what a bear market is. So how do we handle bear markets? Let's first rewind a little bit and go over the definition of what a bear market is. And a bear market is identified by a fall in the stock market for an extended period of time. It is the complete reverse of a bull market. The sharp decrease in stock prices may be due to a correction or overvaluation from a bull market or decline in corporate profits. Remember, we can be bullish or bearish on individual stocks as well as the stock market as a whole. A bear market normally starts with a sudden drop in prices, like the bursting of a bubble from a bull market. Bull bear. Panicking investors resort to selling stocks in large numbers on fears that the prices will continue to decrease. You can kind of see where this is going. As more investors join in on selling stocks, the price drops further, thereby starting a vicious cycle that pushes stock prices lower and lower and lower. So in such a case, here's how the best way to handle this without losing your shirt. The first thing we should remember is that a bear market is bad only if you need money immediately. And if you need money immediately, investing is probably not the first place you should be looking. The falling prices are just an indication of long-term results. Ideally, you want to hold your stocks during these bear market periods. And when I say they're indication of long-term results, you never know how long it's going to fall. It might bounce a couple times on the way down. And when I say bounce, I mean prices might go up a little bit, but when you're in a long-term bear market, prices normally just go down, 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 down. It might take a couple of years. And that's the other thing too. I mean, these things can last months, they can last years. You can have multiple cycles going on at the same time. But remember, we're just covering the basics here. So just get down, bull market up, don't invest, bear market down, time to invest. Understand the difference between stock prices and the underlying value of the businesses which they represent. As long as the business hasn't taken a turn for the worst, you can ignore the price drop and load up on great companies at a deep discount. When you come across the situation where you see the market is falling, as hard as it might be, it's actually the best time to buy, especially if you are in it for the long run. These bear markets are where fortunes can be made in the stock market, and you really don't have to be that clever or smart. I mean, this is where the market comes to you. Bear markets really are your best friend when it comes to investing because great stocks become super cheap compared to their value, and you get excellent investment deals. Finally, we're going to wrap up with, do bulls and bears actually matter? The stock market is in constant movement between bull and bear markets. It's important to understand that there are multiple market cycles. There are cycles that last months, and cycles that last years, and cycles that last decades. We can come up with completely different conclusions about where the market is based on our time horizon. This is why it's so important to decide whether you're a trader or investor. As an active trader, we need to be very conscious and cognizant of the bullish and bearish behavior of the market. Obviously, it affects the overall trend of the market, which is vitally important because it will form a context for your trading decisions. As investors, on the other hand, since we aren't actively in the markets, we don't have to be as vigilant in understanding the current short-term market cycle. As an investor, your time horizon is in years and decades, and as such, we would want to be looking at larger market cycles that span years, as opposed to traders who are concerned about current market cycles that are just over a few months. Thank you for watching. I hope you found this informative and actionable. This concludes Module 2 of the Stock Market Foundations course. If you have any questions, please let me know in the comments section below. And don't forget to subscribe to my YouTube channel so you can stay up to date with the latest investment insights so that you can continue to maximize your investment returns. I'll see you in the next module. To your investment success.